On this episode, Dr. Wade Phau and I discuss 4 approaches financial advisors should consider when managing the sequence of return risk for clients as they head into retirement.
This is the Resilient Advisor Podcast, the show for high-performing financial advisors. We bring you the best practices of the industry's top performers so that you can build resilience in your business and your personal life.
Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter. Joining me for this podcast is Dr. Wade Phau. Dr. Phau is a professor of retirement income at the American College. He holds a PhD from Princeton University, is a CFA charter holder, and director of retirement research at McLean Asset Management. Dr. Phau, thanks for coming on the podcast.
Well, thank you, Jay. It's a pleasure to be here.
So last spring, Dr. Phau had an article published on Forbes.com titled 4 Approaches to Managing Sequence of Return Risks in Retirement. It was and still is a very popular post on that site, and we are going to examine each of the approaches from a financial advisor's perspective. So starting from a high level, the 4 approaches are to spend conservatively, maintain flexible spending, reduce volatility when it matters most, or buffer assets. Dr. Phau, why don't we start with number 1? Could you walk us through some practical applications of the spend conservatively approach for financial advisors?
Mm-hmm. Yeah, and so the whole idea is with retirement, when you start taking distributions from assets, you become more vulnerable to downturns in financial markets. It's not just the average return over a long period of time, but the specific order that those returns come. And so spending conservatively is really, probably everyone is now familiar with the 4% rule of thumb for retirement spending, and that's an example of the spend conservatively approach. You spend a constant amount every year, and inflation adjusted, so a constant inflation adjusted spending level, and you take that from a volatile investment portfolio. That 4% rule of thumb assumes you have 50 to 75% stocks in retirement. And then the whole idea is you just make sure your spending rate is low enough that you don't run out of assets while you're still alive. And then the question really becomes, spend conservatively, how low does that need to be? And the 4% rule of thumb was one offering on how low that spending needs to go.
And what are your thoughts on the 4% number? Should it be lower? Should it be higher?
Well, there's arguments to be made in both directions. If you're going to fit yourself in that spend conservatively framework and not consider the other 3 options that we'll be discussing, I think that number is too high. The problem now is the low interest rate environment that we're in. We really don't have a lot of experience in the U.S. historical data that's been used to say that the 4% rule works, to know that that will still be the case when interest rates are low, and therefore bond returns are lower. And even with a historical equity premium on the stock market, stocks should be lower. Stock returns should be lower as well to keep the same equity premium above lower bond yields. So in this low interest rate environment, 4% is really too aggressive.
I think there's also the dynamic for advisors when working with their clients and coming up with that conservative number, making sure that they stick to that spending. Because people change. Mm-hmm. Make a plan today, and 3 years from now, they might decide they want to spend more, and that really puts the plan at risk, doesn't it?
Right, and that's controlling the whole behavioral side of sticking to your spending plan. And that's another type of retirement spending risk that, we're in a whole other ballpark of discussion if people aren't spending whatever decision rule that they're using to control their spending is not met, if they're spending in excess of what they said they would.
That's right.
So this discussion is really assuming they're going to, you figure out the reasonable budget, the rules to modify that spending level and then stick to that.
Yeah, assuming compliant clients is sometimes a risk in itself. All right, so the second approach that you outlined in the article is to maintain flexible spending. Could you put some color and application on that?
Mm-hmm. So if you're going to use an aggressive investment portfolio, you really should be thinking about letting your spending be flexible and adjust to the market or the portfolio performance. If the stock market is doing well, you could potentially spend more. But if the stock market is doing poorly and the investment portfolio is losing value, then to seriously consider reducing spending as well. And that's a way to help manage sequence of returns risk, because if you reduce your spending when the portfolio is down, you're not getting yourself into this position of having to spend an increasing percentage of what's left to meet that same fixed spending goal and digging a hole for yourself that it becomes hard to recover from. So this decision rule area around flexible spending, this is where probably the most famous rules there. Jonathan Guyton talked about the decision rules for retirement spending, different ways to adjust spending. In particular, you've got the portfolio preservation rule that when the portfolio is declining in value, when the current spending rate as a percentage of what's left gets too high, then you take a 10% cut to portfolio distributions. And that would be really the driving way to help manage sequence of returns risk in bad market environments.
So the approach of the flexible spending approach really needs to be rules-based and not subjective. Is that what I'm hearing from you?
Right. I mean, in real life, people are probably going to be a little bit more subjective and just have this sense that, if the markets are down, they should probably spend a little bit less. But for these sorts of things to be tested in a research setting and to see how they worked with historical data or with Monte Carlo simulation data, you've got to apply a specific rule to guide the spending strategy.
Mm-hmm. It'll be interesting to see if there's a prolonged bear market, how people who take that approach are able to stick to it.
Right. It really requires that commitment, because part of the advocacy for saying that these decision rules are good is they can allow you to spend more initially. But if I'm willing to make cuts to spending later as necessary, I can spend at a higher rate initially than otherwise. So if I start spending at a higher rate and then I don't follow through and reduce my spending when necessary, that can get you into even more trouble than something like the 4% rule, because you're going above 4% under the understanding that you're willing to make those cuts as necessary later on.
Mm-hmm. All right. So the third approach that you talk about is to reduce volatility when it matters the most. What are your thoughts around that approach?
Well, there's a lot of directions that this can go. But to just be clear at the beginning, reducing volatility doesn't mean just putting all the money into bonds or cash. Part of the justification of the 4% rule, it is calling for an aggressive portfolio, holding at least 50% stocks. It's with bonds, you can build a bond ladder and you can know exactly how much you can spend over a specific time horizon. So if I want my money to last for 30 years and I want inflation-adjusted spending for 30 years, I can look at Treasury inflation-protected securities and build a 30-year TIPS ladder. And right now, that would be about a 3.5% withdrawal rate with nothing left at the end of year 30. So if I look at that and say, that's too expensive, or that the spending rate's too low, I want to spend more than that, then bonds are locking in failure. Mm-hmm. And the whole justification for using stocks at that point is to seek the risk premium, the idea that the stock market will outperform the bond market, and that you can, I call it amortizing your upside. You spend more today than bonds would support with the assumption that you will get capital gains from the stock market and justify that higher spending level. And that's really the driver of go ahead and use that aggressive portfolio, that there's confidence in that sort of investment approach that the stock market will perform as necessary. So in terms of reducing volatility when it matters, it's not just simply going into bonds, but it could be like Michael Kitces and I have an article about rising equity glide paths, where you just have a lower stock allocation at the retirement date, but then you let the stock allocation increase later in retirement. And that works as a risk management technique. I think really the most attractive area for reducing volatility is using some sort of income guarantee to pull that risk through some sort of an annuity that provides that lifetime income protection and effectively reduces the exposure of the retiree to the stock market volatility because their spending is covered and they may still invest part of their assets in the stock market. But a downturn in the stock market doesn't jeopardize the ability to meet spending needs because they have separately a reliable income source providing that. And then, well, there's other approaches. There's things like the funded ratio of looking at the ratio of all the household's assets to their liabilities, not taking risk for the portion of assets needed to cover the retirement liabilities. But if they're overfunded, if they have additional discretionary wealth, that's where you could invest that discretionary wealth more aggressively.
Okay, so to be specific, the reducing volatility is about taking that volatility out at the beginning of retirement and then increasing risk over time. Did I understand that correctly?
That would be the rising equity glide path idea, that in terms of reducing volatility when it matters the most, you're the most exposed to market volatility and having that volatility negatively impact your lifetime standard of living when you get bad market returns around the retirement date. And so, yes, you'd have the lowest stock allocation around the retirement date. You could have a higher stock allocation when you're younger. And then what we were saying in that article is also when you're older as well. As you get later into retirement, you can increase the stock allocation again. Now, there are behavioral implications where people might not be comfortable with that, but our argument was more on the mathematical side that this works as a way to manage sequence of returns risk in retirement.
Interesting. I'll put a link to that article in the show notes. And the term that you use is rising glide path. Is that correct?
Right, rising equity glide path. We had 2 articles in the Journal of Financial Planning about that.
Excellent. All right, so the last approach that you outlined in the Forbes.com article is to buffer assets. Can you walk us through that?
Mm-hmm. So buffer assets are assets outside of the investment portfolio that are not going to be correlated with the portfolio or with the stock market. That if the stock market is down or if the portfolio is falling behind, rather than selling assets from a loss and locking in that sequence risk, you draw from this alternative buffer asset. And in the 1980s, Harold Levinsky really developed this idea as having the cash buffer, just having a big pile of cash. And in the 80s, he was talking about even having a 5 years of spending in cash outside of the investment portfolio that you could draw from to avoid selling those investment assets at a loss. And as interest rates have come down dramatically since the 1980s, that's not such an attractive approach anymore. But really the 2 key examples today of buffer assets are the cash value of a permanent life insurance policy and then the growing line of credit on a reverse mortgage. They're both pools of assets that are not going to decline in value when the stock market is down, and so provide that ability to draw from these buffer assets and to not draw from the investment portfolio, with the idea that that will then give time for the portfolio to recover. And so you can then later in retirement go back to spending from the portfolio again. By not locking in those losses, you help to then prolong the portfolio's longevity.
A couple of months ago, I had the opportunity to interview one of your colleagues, Jamie Hopkins, on the topic of reverse mortgages. And I, honestly, like a lot of people in our industry, had a certain dogma associated with reverse mortgages in terms of their utility and where they should be placed. And it was just fascinating learning from him how far those products have come and now the utility as to how they could be used as buffer assets. Where do you see that industry and those products going over the next 5 years?
Mm-hmm. Well, I'm sure Jamie emphasized this point that home equity is a really huge asset that households have, and the conventional wisdom of how they treat it is just really inefficient. And so for a lot of Americans, it's going to be how to be strategic about home equity and Social Security claiming. And so I just see a lot of potential for reverse mortgages to grow in popularity. I thought they'd be more popular by this year because last year there was so much positive press coverage about reverse mortgages that we haven't seen an uptick of their use this year. The rules were modified in October. That it was really too good to be true to some extent, and it's still a very attractive option. But the government has scaled back some of the potential for that line of credit to grow and increase the initial costs as well. So it does at this point, it's a tougher sale to say, let's go ahead and pay this upfront cost and set up this reverse mortgage line of credit as a buffer asset that we may or may not use later in retirement. It was a much easier story when there were companies out there that could set up reverse mortgages at $125. That's no longer possible with the increase in the mortgage insurance premiums being required after October 2nd of this year. But I still see room for reverse mortgages to grow in popularity, and I think financial advisors need to have a good understanding about them because they're going to increasingly receive questions from clients and prospects about the reverse mortgage option.
That's right. And the sophisticated advisors are going to be ahead of the curve, and they're going to serve their clients much better, being already ahead of that. And unfortunately, I think a lot of that will bear fruit once we have a pullback in the market. And the folks who have it set up and they have the buffer assets to help mitigate that portfolio drawdown are really just going to put their clients in a great place.
Right. Yeah, absolutely. The stock market's been going up for years now, and that makes some of these risk management strategies, you haven't needed to manage any risks. So
that's right.
So they're not at the top of mind. But yeah, if we do get a market pullback, you will see that happen.
Could you contrast the buffer asset approach and the traditional bucket strategy that's been around for years? Is it the same approach? You're just taking that first bucket and using assets that are uncorrelated, as you mentioned, the whole life policies and the reverse mortgage?
Mm-hmm. Yeah, the thing about bucket strategies is if you ask 1,000 advisors about the bucket strategy, you'll hear 1,000 different ways that they work. And so I think there are a lot of bucket strategies out there that might sound an awful lot like a buffer asset. I really just think of bucket strategies as you're going to invest differently for different time horizons. And right, you will tend to hold less volatile. Really, I like individual bonds maturing over the next few years to cover those early retirement expenses, hold the more volatile assets for the longer term expenses, and then have a mechanism whereby as you spend down that shorter term fixed income portfolio, you extend it, you sell some of the long-term growth assets and build out the short-term income ladder. And I guess you could kind of treat it as a buffer asset if you're saying, at the start of retirement, I've got 10 years of income covered through my front-end bucket, and I could let that drop down and not have to sell any stocks for up to 10 years at that point if the stock market is down. It's not exactly a buffer asset because it's really going to be increasing your stock allocation. But that being said, it can be hard in practice to distinguish clearly between bucket strategies and buffer asset strategies. They could be pretty similar in a lot of cases, but there's also ways to describe them differently. It's just really, there's no clear way to talk about what bucketing means exactly. So
Gotcha. Well, I appreciate you spending some time with us talking about those four approaches. I'd like to learn a little bit about your company, InStream. What do you guys do at the firm, and what could advisors learn from visiting your site?
Mm-hmm. Yeah, so InStream, it's a comprehensive financial planning software. It's InStreamWealth.com. It can compete with all the other Money Guide Pros and everything else out there. And really what makes it unique in a couple areas are it runs a financial plan nightly. It aggregates all the client data, and then it provides alerts to the advisor that if you put in a threshold that you want the client's plan to have between an 85 and 95% chance for success, then if you see your probability of success falling outside of that range because of the updated Monte Carlo simulations each night, you get to work in the morning, you see these list of alerts, and then you can take action as appropriate with your clients. So it's comprehensive planning software that's really very well integrated into scaling the advisor's business and simplifying, not having to enter all that data by hand, updating the plan nightly rather than on an annual basis. And then as well, what the direction InStream's been moving more recently is to build better capabilities around annuities and showing the impact of an annuity on a financial plan with and without the annuity as well.
Excellent. I'll have links to that site in the show notes. Dr. Phau, I really appreciate you coming on the Resilient Advisor podcast.
Well, thank you. It's been a pleasure to be here.